everybody, and welcome to today's episode of Derek Invest. I'm your host, Derek Miller. What we're going to talk about. So there's a lot of talk right now about what happened with the Fed yesterday. So they cut rates by 50 bips, 0.5%. And what I'm hearing a lot of chatter about is the similarities between 2007 and between right now, and why that's going to create this giant market fall. Nobody's saying crash, but they're talking about a fall. And so we want to talk about the similarities there, and we want to talk about the differences because we're going to get into some charting. So that's the first thing I want to discuss. I want to discuss the similarities and the differences between 2007 and now. I also want to talk about the reaction to the Fed's rate cut, and why does it always seem that when the Fed cuts rates, we have these massive up moves in price. So you can find that across the board. Anytime the Fed makes a major rate cut and we're kind of at a high in the market or a rebound in the market, there seems to be this big pop. I want to talk about why that happens and what that means. I also want to add something in here. I want to talk in both of those scenarios. I want to talk about time frame, because to say that the market's going to drop and that it's like 07, that could mean that, first off, the NASDAQ from September of 2007 to its peak rose over 10%. The S&P rose over 7%, and the Dow rose over 5%. That was after the rate cut, and then all of a sudden it started pulling down. But it was like 6 months later, and we were still at September of 07 levels. So the market rallies, it pulls off, you got to bounce. 6 months later, you're still sitting at those 07 levels. So when people are talking, we need to talk time frames here, and we need to talk microstructure a little bit. And that's something I want to talk about too. Structure of the market. So throughout our entire bull market run, the NASDAQ led the way. Absolutely led the way. Followed by the S&P, and then followed by the Dow. Now, this entire move down, which started on July 11th, the move downward has been led by the NASDAQ. So all of the NASDAQ's down moves were stronger, and the up moves were weaker. As I talked about last week, if you get down into the microstructure and you start looking at each day, what had happened last week was the NASDAQ attempted to take over. So it attempted to become the leader in the rallies, and then it was the laggard in the drops in price. It didn't quite work out. So what ended up happening was the S&P took over, then the Dow took over. But guess what? As of yesterday, the NASDAQ once again is leading the charge upward. The S&P is following, and then the Dow is following. I want to talk about that structure and what that can mean. And if you are someone that swing trades or day trades, or you're simply someone that has their money invested for the long term and wants to miss major bear markets and wants to miss major corrections, you just have to know this stuff. Well, what's going on so that you can identify for yourself, is this the beginning of a rally, or is this the beginning of a more serious bear? Because if this turns into a bear market, this will turn into a pretty serious bear market. What I can tell you thus far is one of the biggest components to a very large bear market or a very large correction is an increase in overall volume, an increase in overall trading activity. So we're going to take a look at that too. Those are the three things I want to discuss today in the next 25 minutes. I hope you enjoy this. I think it should be pretty informative. I've been looking at this stuff myself. I don't trade on the Fed day of the rate cut. I'm not a gambler. And I usually don't trade a couple days after. I let the market settle in. And we're going to talk about why I do that. But even if you're a long-term trader, these can be points at which you should hedge. These can also be points at which you should buy more. This is definitely a market event that does create recourse that is intermediate and to the long term. So let's take a look at it. So first, let's talk about 07. We'll first talk about the similarities of 2007 and the similarities of today. The easiest being that in September of 2007, we had a 50 bip or 0.5% rate cut. Those two events definitely occurred. Something else that occurred is we did have a bear market in the backdrop of both. So from 2001 to 2000, I think the low was actually in 2004, although people reference 2003 a lot. I didn't check the low. But from 2000 to 2003, 2004, you had a bear market in the S&P that dropped 50%. So you had a bear market behind you. In 2001 to 2022, we had a bear market that the NASDAQ was down about 35%. Those are very large, screaming similarities. So we see those two things and we say, okay, this is worth paying attention to. Now, when you're looking at events like that, because we're talking about macro fundamental data, we also need to look at the macro fundamental data. I don't talk a lot about fundamentals on this program, not because I don't believe in them, but because I believe if you're looking at fundamentals, you're looking out over 10 and 15 years. I don't believe the average investor has the ability to hold through those times, because when the market drops 50% or 50 plus percent, I can tell you on every chart that exists, everyone sells. Everyone is taking their 401k to cash. They're selling out of their equities. They're going into conservative funds. It happens every single time, even though everyone denies it. So I'm not that interested in those time frames, because the truth is the fact of the matter is I was a financial advisor for 17 years. I can tell you that I met one person in 17 years that held through 2008, 2009. Everyone else sold at the wrong time and bought back in at the wrong time. Everyone. One person did it. One. Do you know why? They had a $52 million account. Their life was not changed by their investments. If you have $1 million, $2 million, $3 million, $4 million, $5 million, and you lose half of that, it dramatically affects your life. That is why the average investor can't hold through those events. So I am not that interested in that time frame. I'm sorry, it means nothing to me. I know this to be true. I can tell you that the average investor, whether they admit it or not, specifically boomers and retirees, they look at the market every single day. And every day they miss an up move, they get upset. And every day they're part of a down move, they get upset. I did this for 17 years. I was short coming into 08, before any crashes, coming into 08. I got completely out of the market. So I was short as in covered coming into 08. Once AIG announced they were going to file for bankruptcy, that was either March or April of 08, I started getting short. There was a day, and I believe it was January 11th of 2009, or it was right around my birthday, somewhere in January. So I know it was like around the beginning of January, beginning to mid-January. The market popped 16%. I got 20 phone calls. Were we a part of that move? Were we a part of that move? I mean, we were in a free fall. So I know you don't hold, and I know that you're watching. So let's talk about what you should be watching. So 2007, and now we have a bear market in the background. We have a 50 bip rate cut. Now, what was the difference between now and 2007? Well, in 2007, everything was based on this housing issue. So I forget what percentage of loans were interest only, no income check required, and they were subprime. I forget the percentage, but it was an outrageous number. Now, not only was the housing industry being funded and fueled with interest only, no income, just give me subprime mortgages, but the investment world was packaging those subprime mortgages and selling them off in tranches as investments. And there was like one tranche that was any good at all. Everything else was crap. And these things were being sold for like a year and a half. We had completely gotten into you were derivatives of derivatives of derivatives of derivatives. So the amount couldn't even be determined. We couldn't even determine what these assets were worth. We just knew that it was worth trillions less than we thought, right? There was so much leverage, you can't even comprehend. It would make the leverage of an options or a futures market look like nothing. And we were sitting on piles of this crap. Now, so the markets are so insanely overextended, and the banking industry is near failure. And that's a fact. And everybody knew that. When AIG announced bankruptcy, everybody knew what I just said. We were near a collapse. Volume in the S&P, the NASDAQ, and the Dow was up 1,000% per day. Just constantly up. So you had this massive increase in volume. Massive increase in activity. Now, this is before any crashes occurred. This is long before any crashes occurred. This is the setup for before a crash. Now, let's talk about today. All right. Do we have any of that housing stuff going on? Nope. Mortgage applications at an all-time low, supply at an all-time high. Corporate America has been buying houses. Baby boomers are not selling their houses. They're living in them as opposed to selling them and moving into some smaller things. This is not a supply issue. Make no mistake about that. This is an affordability issue. The real issue we have now has nothing to do with housing, absolutely nothing to do with housing. It has to do, there's a greed component certainly in 2007, and there's certainly a greed component now. The difference is in 2007, the greed component was by the people that create these markets. It was the people that run the world. The greed component right now is probably more on the citizens, which is really sad. Trying to get more rent than they know their house is worth. Oh, the market says it's worth this. Damaging each other, damaging each other's families to try to make a buck. It's actually a sad state of affairs, in my opinion. Rent is too high. The cost of homes is too high. And the thing is, they're just not affordable. Not only are interest rates too high, but prices are too high. All right. So is there going to be a reversal in the retail housing market? Unless corporate America keeps buying everything and we all turn into renters in 20 years? Yes. And some of it does depend on the greed of the people right now that own the homes. And I'm not trying to point fingers. There's this that people are coming down on baby boomers because they're not selling their houses and they want these outrageous prices. But the fact of the matter is, this is what the market taught them to do. And they're just continuing to do it. It's their habit, if you will. And it's a lifetime habit and a hard habit to break. And they're not looking at the reason that their kids don't own homes is because, right now, the multiple to buy a home is 5 times your annual income. When they bought a home, it was maybe 2 times your annual income. So they're just not, look, it is what it is, okay? But housing is not the crisis. What's the crisis? Inflation's the crisis. And inflation was created in 2021 when we took 50% of all U.S. currency. We increased U.S. currency in circulation by 50%. A lot of that had to do with the COVID relief fund so that we could line the pockets of pharmaceutical companies and pretend that there was some deadly virus running around. And if you don't like hearing that, that's just too bad. That's what happened. It was a money grab. Just like it was a money grab in 2009 when you had the big bank bailout, which led to the highest bonuses given to bank CEOs in the history of this country. So we paid off the banking industry back then, and we gave those CEOs the highest bonuses in the world for nearly destroying our economy and making most of us broke. And now we just did it with the healthcare industry, aka pharmaceutical industry, through the COVID relief fund. And that is a fact. It is not a negotiable topic. That is what happened. And they also are receiving the largest bonuses they've ever received in history. Those major CEOs that created all those safe vaccines that you took. And if that doesn't upset you, something's wrong. Somebody stole your money and just gave it to other people. And that is upsetting, but not the point of the conversation. The point of the conversation would be, does that world that is completely destroyed through the people that run the world, run the banks, creating these products that no one could kind of even figure out and had no idea how far it could push a market down, no idea about liquidity. I mean, eventually there was no liquidity because you couldn't sell this crap. Are we in any scenario like that? We're just not. Housing is unaffordable. Cars are unaffordable. Groceries are unaffordable. That is why there are more credit defaults on credit cards than there ever have been in history. People are literally becoming broke. You want to know why the Fed cut 50 bips? In my opinion, people are at their breaking point. And I'll tell you one thing that people in charge and run the world, and whether they're the bankers, whether you think there's an Illuminati, I don't care who you think it is. There are groups up there that make decisions that affect the rest of us, and they're the ones with all the money. And look, you milk the cow, you don't kill the cow. And right now, the milking's over. You have to give a rate cut. You have to create some affordability. Otherwise, housing could fall into a crisis, and the American public could fall into a crisis. And when people get hungry, people do crazy things. And I don't foresee that happening, just so you know. So I think there is a dramatic difference between 2007 and right now. A dramatic difference. I don't see the similarities, aside from the fact that we do have a bear market in the backdrop, and we did get a 50 bip rate cut in September of both years. Outside that, I don't see how you can say from a macro fundamental standpoint there are too many similarities. Now, market structure. So we're going to jump over. I'm going to share my screen here real quickly. I want to talk about how the NASDAQ led the charge up, but in what I am going to call a correctionary cycle, in this current correctionary cycle, it has effectively led the market down as well, which makes sense. It's the market leader up. It's going to be the market leader down. Now, when it recovers and begins to lead the market up again, that is the first indication and a major indication that we are on our way out of that correctionary cycle. And the fact that August 5th, I don't believe we definitely haven't reached the lows. I don't know how deep into August 5th we've gotten in the NASDAQ, but it seems to me we came back down and now we're moving up. We could be heading into the next bull cycle. So let's go ahead and take a look at that. And, something I do want to mention to everybody is that you have to remember something when you're listening to people online discuss the market. If you had all the answers to the stock market and you could make all the money, would you really be giving that information away to everyone? I mean, would you? Would you really? I do my best to do that. I do my best to show you what I see in the most honest way. But a lot of these people that have worked for these major firms and and some of them are on the inside of all of this, and they are the purveyors of misinformation. Remember, when you're listening to someone, you have to come to your own analysis because there is so much misinformation out there, and it is brought to you daily intentionally because that makes more room for them to make money. Let's just face it, which is the story old as time, right? If you're in the markets, if you play this game, you can't be mad about misinformation, misdirection, and attempting to help you lose your money so they can make money, because that is the game. So you can't be upset about that. So let's move in to market structure. So in this market move down that began on, I always say July 11th because it's the first move down. I'm going to zoom in on it a little bit. Not that much. How about that much? So on this move down from July 11th, you'll see right here, this is the NASDAQ, okay? I am going to go ahead. This is July 11th. All right, I'm going to put up here July 11th, 24. Okay, right there. That's the high. You'll know why we're going to do this. We're going to take a look at what happens here. So that's July 11th. There we go. 2024. Now we come down. This is August 5th. All right. So this right here is August 5th, 24. Right there. Now, on the rally, the NASDAQ does not come anywhere near its previous high. In fact, we sit there now. So you know what I'll do? I'll just thicken up this line. I am paying, as you can tell, I am paying very close attention to where the NASDAQ is and where the other markets are. So the NASDAQ dipped back in and kind of into that area. If you look here, it dipped into the area. This is September 6th. These dates are important, everybody. '24. Okay? September 6th, 24. Boom. And you can see the level here, okay? You can see this level. Whoop. Where it got down into the 5th, okay? There you go. That is the NASDAQ. Let's actually put that up here. NASDAQ. All right, I'm actually going to screenshot this because we're going to use this. Now what we want to do is we want to go look at the S&P 500. Let's go take a look at the S&P 500. All right, SPY. We're going to leave that there. All right, so here we are. All right. Once again, now your down move does not begin until July 16th. This is July 16th, 24. We're going to move that up. All right. That's July 16th, 2024. This, once again, is August 5th. Right here. This is August 5th, 24. I'm actually going to move this. Right there. And here we are at the reversal on September 6th. Let's go back. These dates should all be ringing a bell, right? September 6th. So here we are at September 6th. Now, does anybody see the glaring difference? 24. Does anybody see the glaring difference here in their price levels? Look at the price level here. Look where it is. It's definitely nowhere near as low as the NASDAQ was. And now, today, we've broken to a new high. We've broken to a new high. Let's take a screenshot of that. We're going to need that. And now let's go take a look at the Dow. So the Dow looks completely different, obviously. All right. So the previous high that we have been looking at is way down here. And in fact, it's not. It's even further. So your July 16th is way back here. Way back here. July 10th, 11th. 12th, 13th, no, 15th, 16th. Here we go. So this is July 16. Right here. July 16. Sorry, I know this takes a minute, but it is worth it. July 16th, 24. Let's go ahead and give us an arrow right there. You have a new high on July 18th. So July 18th, 24, new high. You have a new high on August 30th. August 30th. New high. Scooch this over. And here we are today. Higher even yet. Also, let's go back. If you remember, when was September 6th? September 6th is right here. So let's go to September 6th. September 6th. which, by the way, was the low for the NASDAQ and the S&P, September 6th, 24. There we go. Which was the low for the S&P and the NASDAQ, but the Dow on September 11th. Hold on, I'm going to do this. I'm trying to figure out a way to arrange this where it makes sense. September 11th. September 11th, 24, new low. So it made a low after the Dow and the S&P, or after the S&P and the NASDAQ. Now, what does this mean to you when you're evaluating market structure? Well, it means this exactly. First off, it made a low after the NASDAQ and the S&P had already reached their lows. So now what you would say is that the Dow led you to a lower price first. Since this move, let's not look at the previous high. It did break out to a new high, which makes a great story, right? But, and this is the high of 2021. So it broke out to new highs, as we can see. But how much did it break out to new highs? So give me 1 second here. Now we're going to compare the three. So on the macro structure, what we see is that the NASDAQ was going much lower and reversing much lower than both of the other indexes until September 11th. On September 11th, the Dow made a new low. Let's look at the S&P. The S&P did not make a new low on the 11th. This is the 11th, right? It came down, that it touched the bottom. So your low's 539.44. And your low on September 11th is 539.96. So it did not make it back to the low. Let's now look at the NASDAQ. What did the NASDAQ do? So the low on September 6th is 448.19. What's the low on September 11th? The low is 451.28. 451.28 versus 448.19. That's almost a full percent higher. And since then, this was the NASDAQ's previous high. It's looking to break out today. And this is the previous high of July 11th, if you remember. And then back here is the previous high of 2021. So here's July 11th. So what do we see happening? It looks like the NASDAQ has now taken hold of the upside move. The Dow is now going to fall deeper and rise in a more shallow manner. It looks to me like a market structure reversal. For now, since September 6th, we are in a market structure reversal. Is this how lows happen? Is this how corrections end? Typically, yes. That is the answer. Typically, yes, this is how they end. So if we look at the NASDAQ, once again, it goes deeper than any other index into August 5th. It rallies more shallow. It falls deeper, but now it's leading the price rise up. Okay? It is back to its previous high level, and it is looking to break to a new high. The S&P, look, it fell. It rose back to its previous high, and it's even broken the previous high. It has broken the previous high. However, it almost came back to its low levels on September 11th. The NASDAQ did not. It was 1% higher. And the NASDAQ has had a much bigger rally since September 11th. In fact, let's do the math. And I haven't even done this math. So the low's 539.96. Let's call it 540. Right now, you're at 570. You're at 30 points on 500. So you'd be looking for 50 points. So you're looking at about 5%. Let's go back to the NASDAQ. The NASDAQ since September 11th, its lows are 451. Let's just call it 451. Today it sits at 485. That's 35 points. Effectively, at 451, you need 45 points. You're up about what, 7%, 7.5% in this rally. Let's go over to the Dow. The Dow's low on September 11th was 400. We now sit at 420, 400, 420. So you're looking at about 5% there. So the S&P and the Dow are really close. The NASDAQ's definitely leading at the charge at a 7% run up. So now, because this structure has changed, what we'll need to do, whether you're swing trading, intermediate trading, or long-term trading, is our eyes are going to be on the NASDAQ now. There was a gap this morning that's going to need to fill. It's going to need to fill to build a real substantial rally. I imagine when that gap fills, everybody's going to say, this is what I've been talking about. I hope you're short. I hope you weren't long into the Fed meeting. I imagine that's going to be the conversation. But it does appear as though the intermediate market structure, the NASDAQ's leading the way. Once it breaks to a new high, and if it does in fact take off, which we'll find out, if it does in fact take off, then the NASDAQ will be the leader in a new bull. We'll probably finish this year up 30%. But let's take a look at what will be needed for that to happen. So I'm going to stop sharing for a moment. One of the things we need to see, and I talked about it, was volume. So you have to look at volume whenever you're looking. So trading activity, whenever you look at whether we're heading into a major correctionary cycle or whether like major correctionary, or whether we were in a correction and coming out of a correction. So what we'll need to do is we look at those high prices and we look for volume. And in fact, right now, there isn't any. There isn't any volume at the moment. If we're going to head into a major correctionary cycle, volume is going to spike. In 2021, the first week of December, the NASDAQ and the S&P were operating at about anywhere from 300 to 500% more average daily volume at those price highs in 2021. We do not see that today. We do not see the volume necessary for a reversal. We can pay attention to the NASDAQ and see if we do believe we're seeing that, if we do think that that's occurring. And if that volume does step in, if that trading activity does step in, we may be headed for something pretty ugly. But for now, what I would say is it doesn't look like we're headed for anything ugly. We're not headed for anything ugly in a macroeconomic situation. It looks like the Fed just did the intelligent decision. You can't have people if people can't feed their families, bad things happen. So to me, that's all that happened. Whereas the Fed was actually trying to create liquidity in 2007 because they knew that the investment world got so greedy that there was no money left and people could not sell what they owned. That is a massive problem. We do not have a problem like that. So I would say if I were looking at this, and I'm not looking at this to be bullish or bearish, I'm looking at this just to say what is happening with market structure and what is happening on a macroeconomic scale. On a macroeconomic scale right now, there are problems. There are not major problems. We do not have the volume or trading activity to facilitate what I would call for a move in a downward direction. Also, the microstructure and kind of intermediate structure looks as though the NASDAQ is taking back over. So we should see that come to fruition. My guess is that gap has to fill in the NASDAQ. There's a couple gaps in the Dow that should fill. And it looks like we are going to have a price run up through the end of the year. That's what I see. That's what I see for today. So I appreciate every one of you. Please like, share, comment. I'm building this in hopes that my fair and unbiased, I have no bias in my views, and the balanced perspective that I bring to the table, looking at fundamentals and technicals, I'm hoping that it rings true for some people. So I appreciate all of you. But please share this, like, and comment if you do enjoy it. Outside of that, I appreciate it. Always remember, if you're not good up here, you're not good anywhere. If you're having a rough day, if things seem like they're overwhelming, get outside, go for a walk, take a look at the sun, smile like an idiot. Fake it till you make it. It does work. Believe me, it works. I used to do it in my cold calling days, and you could actually have a lot of fun cold calling as long as you kept the right attitude. You haven't failed yet, so you don't have to worry about failure. You're still here. You're still trying. You're still going. So the fact of the matter is you've never lost. I don't think there's any reason you're going to lose now. And always remember, everybody, the most important thing that I say in any program is this. Every day above ground is a good day. Celebrate it. Enjoy it. Get out there and show others that you enjoy it. Hard times are going to come. They're also going to pass. That's the way it goes. It's a thing called life. So remember, this is another great day above ground. I'll see you all soon.